Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled U.S. Citizens Living in Israel, Trust, Real Estate, and Income Tax Considerations for a Dual Tax Person. For those who don't know me, my name is Jonathan Shenkman, and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15 to 20 events I run every year, I also do a fair amount of writing on the topics of financial investing and financial planning. You can read my work in Barron's, Forbes, Kiplinger, the Wall Street Journal, a CPA Journal, Trust and Estates Magazine, and many other periodicals. My most recent piece was published in Forbes entitled 7 Strategies to Generate Sufficient Cash Flow in Retirement. After the program, I'll send out a link to this article and a variety of other periodicals where I publish my work. Today, we are privileged to hear from Boaz Feinberg, partner and head of tax at Tadmor, Levy and Company based in Tel Aviv, Israel. Boaz has 20 years of experience in domestic and international taxation as it relates to both M&A and high net worth individuals. He has experience guiding his clients when it comes to tax planning and various other complex international transactions. In this capacity, Boaz provides implementable legal opinions relating to direct and indirect tax branches, international tax and trust, and leads negotiations vis-a-vis Israeli tax authorities and the district and state's attorneys' offices. Well-versed in the issues of facing trust, he advises various trusts throughout their life cycle and represents clients before the Israeli tax authorities, the Israeli Voluntary Disclosure Program, and more. Today, Boaz will be speaking on U.S. citizens living in Israel, trust, real estate, and income tax considerations for a dual tax person. And with that, I'll turn it over to Boaz.
Thank you very much, Jonathan, for the warm introduction, and thank you for hosting this event. And hello, everybody, from here in Tel Aviv. And my name, again, is Boaz Feinberg, and I'm head of the tax practice at Tadmor, Levy, and co-law offices here in Israel. And we are going to discuss taxes. We have half an hour to cover quite a lot of material. And so we'll get right into it. It's going to be an overall or an overview of the infrastructure, the legal infrastructure relating to taxation of new immigrants coming in from the United States into Israel. And what happens when they make their immigration into Israel, and how does the tax affect those who either are still having some kind of business outside of Israel or passive income outside of Israel, alongside with those who are planning on retiring while immigrating into Israel. And at the end, and I hope I have enough time to work on that, because that is definitely one of the more sophisticated and complicated issues, trust. What happens when there is either a seller or a beneficiary of an existing trust and making aliyah, immigrating into Israel? How does that affect them from an Israeli tax perspective? So here's the agenda. We'll start with a short overview of the legal infrastructure. We'll discuss the 10-year tax holiday for Ulim, passive income, capital gains, real estate, and we'll end with trusts. I deliberately, since we're only short on time and have only 30 minutes to go over pretty vast amount of material, I kept out anything to do in this session with regard to taxation of business income. And hopefully, Jonathan will be able to have additional webinars and we can talk about those issues as well. All right, so legal infrastructure, just a quick overview. You have two major pieces of legislation that affect the taxes in Israel. One is the income tax ordinance, and the other is the purchase and sale of land tax law. There is, of course, indirect taxes in Israel. We will not discuss these at this point. There is value-added tax, there is sales tax and customs, but again, this is not relevant to new immigrants. And of course, it could be relevant if they have a business, but but we will today focus on the income tax ordinance and on real estate taxation. A clear overview of definitions. Aliyah, it means immigrating into Israel. If I use the term aliyah, that means immigrating into Israel, leaving your residency in the United States and coming in to Israel to live in Israel. Anoleh is a new immigrant. And an Israeli resident, this is a little slightly different definition than the others, being a tax definition. An Israeli tax resident is an individual whose center of life is held in Israel, and I want to be very clear about this. Many people believe that if they come to live in Israel, and as Jews, they are of course allowed to live in Israel, and they are automatically welcome here as citizens. But if you think that not becoming a citizen of Israel means that you will not become a tax resident, then you are then you are mistaken. And the real test related to Israeli residency is center of life test. Whether or not your center of life is in Israel will determine whether you are an Israeli tax resident. And of course, center of life may include a permanent resident, your financial, your family ties, your social ties, whether those are in Israel or elsewhere. And if they are all in Israel, despite the fact that you didn't make the technical immigration and got the Israeli citizenship, that will not make the difference. The difference will be whether you are, your center of life is in Israel. So that's a very important thing that you should note. I know that many Israelis, many US citizens who made Aliyah came into Israel, but didn't actually technically make the Aliyah procedure and became citizens. That does not mean that they're not eligible to taxes in Israel. The 10-year tax holiday, this is the current legislation. There are always discussions about the possibility to amend the existing legislation, and it provides for a 10-year tax holiday on foreign sourced income, which means any kind of income that was derived or generated outside of Israel. And it is for a period of 10 years from the time you actually become an Israeli resident for tax purposes. Meaning once your center of life is in Israel, then your 10 years tax exemption begin. And in addition to the exemption on the tax, there's also an exemption on reporting, on filing tax returns with regard to any foreign sourced income. And again, this is the current legislation. There are discussions specifically with regard to the reporting exemption, which the Israeli tax authorities are looking to repeal as soon as they can. And also discussions with regard to the exemption on the tax, which again, it's not clear what would be the outset of this of these discussions. There may be a change in law. But again, the current law today, 10 years of tax exemption on any foreign sourced income. In addition, you have, if you are considering immigrating to Israel and haven't yet decided whether you wish to remain in Israel, you have an optional adjustment year, which allows for people who came into Israel to live here for the first year to consider the possibility to live here. And if they decide at the end of that year that they wish to go back to the United States, they are allowed to do so, and they will not be considered Israeli tax residents for that first year. You need to elect to do this before your year begins. You have a period of 3 months to choose this election and to notify the tax authorities. And if you decide after that first year that you are staying in Israel and becoming an Israeli resident, that first year you will be considered an Israeli tax resident. And the other thing that new Olim are entitled to is the 3.5 years of special tax credits on the income that they generate in Israel. Passive income, again, if it's sourced outside of Israel, you will be exempt on those kinds of particular income. It could be income that is generated from dividend distribution, interest on loans, And it can be also on rental income, provided, of course, it is passive and does not become a business income. And if it is generated in Israel, then usually with regard to dividends and interest, well, we'll begin with dividends. If passive income is generated inside Israel, then individuals who are not substantial shareholders of the company would pay 25% on the distribution of dividends. And if you're a substantial shareholder, which means that you either own at least 10% of the issued shares of the company, or you have 10% in the voting rights, or 10% entitlement to receive profit from the company, or if you are entitled to nominate a board member, then you would be considered a substantial shareholder, and then any kind of distribution of dividends would be taxed at a 30% level. I will tell you another thing is that you have a surtax of 3% on any kind of income, provided that your taxable income in a year exceeds 651,000 shekels, which adds another 3% to any kind of tax rate that I am now discussing. With regard to interest income, again, if you're a regular individual, you provided a loan to a company and you're not a substantial shareholder, then you would be taxed at 25%. If you are a substantial shareholder, however, you would be taxed at a marginal tax rate, which can go all the way up to 50%, 50. And if you're providing an interest, a loan that is not linked to CPA assets, then you may be eligible to a 15% tax rate on the interest. With regard to rental income, if it's rental income on residential apartments held in Israel, unlike outside of Israel, then you may pay either a marginal tax rate if it's treated as business income, or if you elect to do so, which again, marginal tax rate can go all the way up to 50%, or you may elect to pay only 10% on the gross income for non-business income. The question, what makes rental income into business or passive, is elusive. There was a Supreme Court verdict with regard to people who held more than 20 apartments, and they, of course, held that holding more than 20 apartments, renting out more than 20 apartments is, of course, business and is not a passive nature of income. Again, with regard to any kind of rental income that you make outside of Israel, if you keep on holding assets that you hold outside of Israel, then for the first 10 years you are tax exempt on those. And after the 10 years elapse, you would either pay marginal tax rate on that passive income, or you also may elect to pay only 15%, 15% on the rental income of any kind of real estate outside of Israel, but then you will not be entitled to any kind of tax credit that is paid in the United States, or to any other expense against the income of the rental. With regard to pensions, this is particularly important for people who are retiring and are coming into Israel. There's a special exemption that is applicable to any person who makes Aliyah. Their pension will be subject to tax at the rate that would have been paid by them if they wouldn't come to Israel. Which means, so for instance, if there is a Roth IRA and you are paying zero taxes on the income generated in the Roth IRA, and you make Aliyah into Israel, you will continue to be taxed at a zero tax rate on that Roth IRA. It is important to note, however, that if your pension is not something that you generated yourself from your employment, but rather you received an IRA from your parent as an inheritance, then this specific exemption will not apply, and you will need to pay taxes on not necessarily the distribution, unlike in the United States, when usually you may end up paying taxes only upon distribution of IRAs, but any kind of annual income that those IRA generate, you may find yourself paying taxes. Again, of course, we're discussing what happens after the first 10 years of your tax exemption. So that was passive income. Now let's move on to capital gains. With regard to capital gains, first 10 years, as with passive income, as with business income that is generated outside of Israel, the first 10 years would be tax-free. And let me be clear about one other thing. It doesn't matter, and it's irrelevant, if you purchased the real estate before or after you made Aliyah. You can immigrate into Israel, and with the funds you have, you may purchase more assets outside of Israel, and any kind of sale that will be made upon those assets during the first 10 years of your immigration will not be taxed in Israel at all. Extended to assets located abroad, acquired after becoming an Israeli resident. At the end of the holiday period, CGT will be calculated on a linear basis. And what does that mean? That means that if, for instance, here's an example, you purchased an asset in the year 2010, you immigrated to Israel during 2015, you ended your tax holiday at the year 2025, and you sold the asset at the year 2030. In that kind of situation, you would only pay 0.25% of the portion, meaning that the amount you spent either outside of Israel or during your first 10 years will not be calculated as part of the taxable profit on that sale. Tax rate on capital gains in Israel, after your 10 years have ended, you would pay 25% as individuals, and if you're selling stock of a company in which you are a substantial shareholder, once again, it will be 30%. And I'm reminding you again, there is the surtax. So if your taxable income is higher than 650,000 shekels a year, then you would find yourself paying an additional 3% to those rates. With regard to real estate taxation, so Section 9A, specifically I want to discuss the purchase tax. The sale of real estate, generally speaking, is similar to capital gains. You may have some exemptions with regard to holding only one apartment, but I wanted to discuss specifically the purchase tax. With regard to purchase tax, in a real estate transaction, the purchaser is required to pay real estate purchase tax, which would be relative to the value of the sale or by a fixed amount, depending on the type of the sale and the type of the real estate. So you have, in general, two different kinds of real estate that are treated differently for tax. One is either vacant land or commercial, and the other is a living apartment. With regard to land and commercial real estate, you pay a fixed price, fixed tax rate of 6% and may be reduced to 5% if there's a plan on construction on the land for residential apartments. And if you are planning to purchase an apartment, then generally speaking, before entering into any special exemptions, you have tax brackets that are between 5% to 10, depending on the value of the purchase. This is, as I said, the general rule, but if you are an Israeli resident and you purchase only one apartment and you own only one apartment after that purchase, then you will be eligible to a different tax rate, a much lower one, with brackets that begin from 0 and go all the way up to 10%. And they are listed here in the slide. This, of course, is only applicable if you are an Israeli resident. And that means that even if you are planning to make Aliyah, you have 2 years from the date that you purchased the apartment and until the time you made Aliyah, and you will still be eligible for the same special tax exemption that is applicable to one apartment. All right? So if you manage to do this within the 2 years from the time that you purchased the apartment and the time that you made Aliyah, you will be able to get the same exemption. Another special exemption for new immigrants, for Olim Chadashim, and this is applicable only to those who are actually new Olim and not to those who used to live in Israel and left and came back again. there are some special cases in which, even though you did spend some time in Israel, you still may be considered a new immigrant. For instance, if you came here when you were younger and you were in the military service, or you were here for a short period for your high education, in any other event, you must be a new Oleh in order to enjoy the special exemption, which applies to any number of apartments that you own, but only on one apartment, and it has to be on your dwelling apartment, meaning that you must live in that apartment after you have purchased it. And then you will be eligible for a 0.5% first bracket up to 1.8 million shekels, and anything above that on a flatted rate of 5%. And those who are considering whether to use the first apartment exemption or the new Oleh exemption, it really does depend on all sorts of issues that you need to consider. First of all, whether you indeed hold only one apartment or not, if you are planning to purchase additional apartments, and so on. And now we have 10 minutes to go, and we're discussing trust, which is indeed the more complicated issue that we're discussing. Taxation of trust was introduced to Israel in 2006. Before that, there was no special treatment to taxation of trusts. In 2006, it was presented, and there was new legislation. And in 2014, there was a major amendment to the legislation, which we are now discussing. Now, since 2014, this is the current legislation regarding this issue. So just as a first rule of definitions, you have the settlor of the trust, you have the beneficiaries, and you have the trustees. The settlor is the person who usually is the establisher of the trust. Beneficiaries are those who receive income or the capital from the trust. And the trustee is the person or entity that manages and distributes the funds. So as of 2014, trusts are subject to reporting obligations and Israeli tax on profit in the following general instances. One is if the settlor is an Israeli resident. The second is if one of the beneficiaries is an Israeli resident. And we will talk about this further, what happens when there are several beneficiaries, one of them in Israel who made Aliyah, and the others have remained in the United States. What would that mean? And third is that there is an asset of the trust that is located in Israel. This is one thing that should be very, very clear. The obligation to report and pay taxes on the trust assets is usually borne by the trustee, but in certain circumstances, for instance, if there is a foreign trustee and a beneficiary in Israel, the beneficiary himself would be obligated to the reporting of the trust, declaring the existence of the trust, and filing annual returns for that trust. In most cases, and this is actually the good news regarding the taxation of trust for new immigrants, the first 10 years, as with holding directly assets outside of Israel, the first 10 years would be tax exempt on any kind of income that the trust is generating, provided, of course, that the assets of the trust are located outside of Israel. This is, of course, only applicable if there is no, in addition to the beneficiary who made Aliyah, any other beneficiaries who are already after their 10 years tax exemption. In that kind of situation, that trust may be still subject to taxation in Israel, regardless of the fact that there is one beneficiary who made Aliyah. So the special rule regarding foreign beneficial trusts, and this is with regard to the situation where the settlor made Aliyah. So as we said, for the first 10 years, the settlor makes Aliyah. He is now living in Israel. He is tax exempt on any kind of income that the trust that was settled by him before he made Aliyah or during his Aliyah, and he is exempt on the first 10 years. But after those 10 years elapse, he may be now starting paying taxes. The trust has to start paying taxes in Israel on the entire income. There is a way to go to get through this if the trust is created by the settler prior to making Aliyah, right, before he immigrated into Israel, and if he meets the following criteria. One is that we are discussing an irrevocable trust, and we'll talk in a minute about what that means. It's not necessarily what you think it means. It is a tax definition, and also provided all beneficiaries during the examined tax year are foreign residents and can be identified separately, including, of course, unborn beneficiaries. So, for example, if there is a person who made Aliyah, he established a trust before making Aliyah, and he has beneficiaries who live outside of Israel, and he designated them specifically and had identified separately each beneficiary and what he is entitled to receive from the trust. In that kind of situation, and provided it's an irrevocable trust, the trustee may claim that the income of that trust is not taxable in Israel and is not part of the Israeli tax net. Naturally, of course, any transfer of assets to the trust after the end of the 10-year may be considered a sale, because if the trust is outside the net and you transfer a new asset that used to belong to you and you transfer it to a trust that is outside the net, that will be considered a sale of the asset by the settler to the trust. So what is an irrevocable trust? First of all, it's not a revocable trust. And we'll discuss exactly what that means in a minute. And the second criteria is that the trustee and the settler must declare in an affidavit to the Israeli tax authorities that the trust is an irrevocable trust. So what applies a revocable trust? You have 10 separate possibilities that are not necessarily intuitive, but do have a logic that trust would be considered revocable. The first one is that if the trust holds an option to revoke the trust or its assets or funds can be transferred or returned to the settler. And that is, of course, the general rule of a revocable trust. If the settler himself has the possibility to revoke the trust, then naturally it will not be considered irrevocable. Second criteria is that one of the beneficiaries or his spouse is the settler of the trust. Now this can start getting tricky because this also applies to the spouse of the settler. And if the spouse is a beneficiary of the trust, that would automatically turn that trust into a revocable trust and will not be eligible to be considered an irrevocable. The third criteria, one of the beneficiaries is the settler's minor child, or if it is possible to transfer an asset or income to such a child while the settler is still alive. Fourth criteria, one of the beneficiaries is a corporation in which the settler or his spouse or a minor child holds 10% or more of the controlling means in the corporation, what we call a held corporation. Fifth criteria is that the trustee or the protector of the trust is the settler of a held corporation. Sixth criteria is whether the trustee or the protector are close relatives of the settler. Again, this is something that it may be an issue for many trusts in which the settler wishes that the trustee or the protector at least would be a close relative of the settler to make sure that the trust is operated correctly and in the manner in which the settler wished for it to be managed. The seventh criteria of turning a trust into a revocable one is that the settler or his close relative have the ability to control the trustee's actions. And of course, this is naturally the case in a revocable trust. The eighth criteria is that one of the beneficiaries is unidentified unless it was proven that he or she is not the settler's spouse, minor child, or a held corporation. Ninth criteria, the trust beneficiaries have been replaced by other beneficiaries or new beneficiaries who were added without the trust declaration having supporting language to do so. And the final 10th criteria, if the trust was not declared an irrevocable trust on time. So naturally, this sounds like a technical issue. It is definitely not a technical issue. You must declare the trust an irrevocable one in due time, which is usually within 60 days from the time that you are requested to do so. What happens when a beneficiary makes Aliyah, not the settler? Again, if a beneficiary is an Israeli resident, then that trust may be eligible to taxes in Israel just for having one beneficiary, an Israeli resident. So a beneficiary makes Aliyah, turns the trust into an Israeli beneficiary trust, which is subject to reporting and taxes in Israel. But as we said at the offset, the trust will be exempt from tax for the duration of the tax holiday, the first 10 years of the immigration, as long as there are no other Israeli beneficiaries who are not Olim themselves. So what are the ways in which, even though there is a beneficiary, one of our family members, one of our children, have decided to immigrate to Israel, and we don't want to find the trust that we created in the United States with mostly US beneficiaries, not to start paying taxes in Israel? So there are a few solutions. One of them may be the designated trust solution, which means that there is a specific allocation of the trust fund to the beneficiaries in a manner that can be seen as designated to each beneficiary, and it has to be an irrevocable trust. And of course, this means that if there are already trusts that are irrevocable, they are revocable because they have met the 10 criteria that we discussed, then there is an issue and we need to figure out a different way to tackle the issue. You will not be able to use the designated trust solution. One other solution that we usually recommend is dividing the trust before the beneficiary makes Aliyah. Again, if possible, if the trust declaration has language that allows for a separate distribution or a different allocation of the trust to sub-trusts, with having the beneficiary who is in Israel be separated from those who are not living in Israel. And in the worst case scenario, if there's no other alternative and you want to avoid the situation of having the trust being taxable in Israel on its income, then in severe cases, you may consider even exiting the trust, again, if possible, and if there's no other alternative that we can try and figure out based on the declaration of trust, the language of the trust, and the provisions of the Israeli tax ordinance. And my final recommendation, and I think we're almost past our time, we always recommend seeking a legal opinion with respect to the application of the holiday period on declarations and reporting, because you have a mismatch in which, on one hand, if you're not a holder of a trust, you are exempt on reporting any kind of income that is generated outside of Israel, but there is not specific language that allows you to have the same exemption on reporting if we're discussing trusts. We believe that a legal opinion does provide you the safety of doing so, even though the language is a little bit ambiguous in that situation. And that's it. My time is done. It's over. Great. And if there are any questions and answers, then I'll be happy to answer them. And it was a pleasure. Thank you very much.
Thank you so much, Boaz. I know that we had some questions. We just have a limited amount of time here, so I'm happy to have a follow-up program. And if anyone has any interim questions, feel free to reach out to Boaz, and I'll leave his contact information in the follow-up email to this program, or reach out to me, whatever is appropriate. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Just two quick items before I let you go. After I end this webinar, a one-question survey will show up in your browser. Since Boaz covered a lot of material in a very short period of time, the question simply asks if we have one more webinar that's a more in-depth topic, what would you want it to cover? And just click it, and then I'll be able to look at the results. And finally, my next program is on November 2nd at 8:30 a.m. and is entitled 2020 Election Playbook, Wealth Planning Ideas ideas and perspective for all investors, and will be given by yours truly, Jonathan I. Shenkman. You'll be receiving an email tomorrow morning with more details and registration information for this and all of my upcoming webinars. I hope you can attend. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.
Thank you.
Have a good one.